Listen, cash is not safe in 2026. It never was. But this year, the conditions have aligned in a way that makes holding significant cash positions one of the most destructive decisions you can make with your capital. I've watched this pattern emerge across 4 decades, and every time it shows up, the same thing happens. People who think they're being conservative get quietly destroyed while convincing themselves they're protected. I'm not here to make you feel comfortable. I'm here to protect capital. And if you're sitting on cash right now, whether it's 20% of your portfolio or 80%, you need to understand what's actually happening to that money while it sits there doing nothing. Because it's not doing nothing. It's losing value, consistently, predictably, and irreversibly.
The game has changed.
The environment we're in right now rewards deployment and punishes hesitation. And the people who don't adjust are going to spend the next 5 years watching their purchasing power evaporate while they wait for safety that isn't coming. Let me start with something most people refuse to accept. There is no such thing as a risk-free position. None. When you hold cash, you think you're avoiding risk. You're not. You're just choosing a different risk. You're choosing the certainty of loss through inflation over the possibility of loss through market volatility. And that trade, certainty of loss versus possibility of loss, that's not conservative. That's just bad math. Here's what I mean. When you hold cash in a savings account or money market fund, you're earning what right now? 3%? 4% if you shopped around? And inflation is running at what? 3% officially, but anyone buying food, paying insurance, or covering healthcare knows it's closer to 5 or 6% for real-world expenses. So you're losing 1 to 3% annually in purchasing power, guaranteed. Now, people justify this by saying they're waiting for the right time to deploy. They're waiting for a crash. They're waiting for certainty. They're waiting for someone to tell them it's safe. And while they wait, their capital is being destroyed. Not dramatically, not visibly, but slowly, steadily, compounding in the wrong direction. I've seen this destroy more wealth than any market crash. Because market crashes are temporary. Inflation is permanent. When the market drops 30%, it recovers. Always has. Always will. But when inflation takes 3% of your cash every year for a decade, that's gone. You're not getting that back. There's no recovery. There's no rebound. It's just wealth transfer from you to everyone who owns assets that appreciate faster than inflation. And 2026 is shaping up to be a particularly brutal year for this dynamic. Because we're at this interesting point where rates are still elevated enough that people think they're getting paid to hold cash, but not elevated enough to actually beat real inflation. So you have millions of people convincing themselves they're being smart, they're being patient, they're waiting for their moment, and they're bleeding capital every single day. Here's what you need to understand about the current environment. We've been through a rate cycle that broke a lot of people's assumptions about how money works. For 15 years, rates were at zero. Cash paid nothing. Bonds paid nothing. Everyone was forced into risk assets just to generate any return. Then the Fed hiked rates faster than they had in 40 years, and suddenly cash started paying something again. 3%, 4%, 5% at the peak. And that created this psychological trap. People who had been starved for yield suddenly felt like they found safety. They moved money into money markets, into T-bills, into high-yield savings accounts, and they felt smart doing it. Because for the first time in a decade and a half, they were getting paid to hold cash. Finally, they thought, a safe return. But here's what they missed. The only reason cash was paying 5% is because inflation was running at 8, 9%. The Fed wasn't giving you a gift. They were trying to slow down an economy that was overheating. And now that inflation has come down, officially at least, those cash rates are coming down too. We're already seeing it. Money market yields are dropping. High-yield savings rates are dropping. The window where cash paid anything meaningful is closing. And that means we're heading into an environment where cash pays 2 to 3%, inflation runs at 3 to 5%, and you're back to losing purchasing power every year. Except now, people have gotten comfortable holding cash. They built it into their strategy. They've convinced themselves it's part of a diversified portfolio, and they're going to ride that position straight into irrelevance. I've seen this before. 2008, 2009. People got scared, went to cash, and then sat there for years while the market doubled, tripled, quadrupled off the lows. They were waiting for safety. They were waiting for confirmation. And by the time they felt comfortable getting back in, they had missed the entire recovery. They didn't lose money in the crash. They lost it in the recovery by not participating. And that's what's going to happen again if you're holding significant cash in 2026. You're not avoiding risk. You're guaranteeing underperformance, and you're doing it at the exact moment when deployment matters most. So let's talk about what you should actually be doing with that cash. Because I'm not saying spend it. I'm not saying gamble with it. I'm saying deploy it intelligently into assets that have historically protected and grown wealth through inflationary periods, through rate cycles, through economic uncertainty. And there are very specific places that make sense right now given where we are in the cycle. First, dividend-paying equities in defensive sectors. This is not sexy. This is not exciting, but it works. When you hold cash, you get maybe 3% and you lose purchasing power. When you hold a portfolio of high-quality dividend stocks yielding 3 to 5%, you get that same income, but you also get price appreciation, dividend growth, and inflation protection. Let me give you examples. Utilities, consumer staples, healthcare. These are sectors that perform regardless of economic conditions because people need electricity, they need food, they need medicine. Demand doesn't disappear. And the companies in these sectors have pricing power, which means when their costs go up, they pass it on. That's inflation protection built into the business model. And here's the key. These companies increase their dividends over time. So you buy a stock yielding 4% today. 5 years from now, it's yielding 6% on your original cost because they've raised the dividend 3 times. That's compounding income. Cash doesn't do that. Cash pays you the same amount forever, while inflation makes it worth less. Now, I'm not saying buy any dividend stock. I'm saying buy quality. Companies with strong balance sheets, consistent cash flow, and decades of dividend growth. The dividend aristocrats, the dividend kings, companies that have raised their dividend every year for 25, 50 years. Those companies exist because their business models work through cycles. And right now, with the market focused on growth stocks and AI and speculation, a lot of these defensive dividend payers are reasonably valued. You're not overpaying. You're not buying at peak multiples. You're getting quality income-producing assets at fair prices. That's the opportunity. Second, short to intermediate term bonds. I know, bonds have been a disaster for the last 3 years. Everyone who bought bonds in 2021 got destroyed. I get it, but that's over. We're at the back end of the rate cycle now. Rates are coming down. And when rates go down, bond prices go up. That's just math. So if you're holding cash earning 3%, you can move into a 2 to 5 year treasury or investment-grade corporate bond yielding 4 to 5%, and you get higher income plus the potential for price appreciation as rates decline. And if we hit a recession, if the market gets volatile, if there's a geopolitical shock, bonds go up. That's the defensive piece of your portfolio. Now, I'm not saying go long duration. I'm not saying buy 30-year bonds. I'm saying short to intermediate, 2 to 7 years. You get most of the yield without taking massive duration risk. And you position yourself to benefit when the Fed continues cutting rates, which they will if the economy slows or if anything breaks. This is basic portfolio construction, but most people aren't doing it because they've been conditioned to hate bonds after the last few years. That's recency bias. That's letting recent pain dictate long-term strategy. The wealthy don't do that. They look at where we are in the cycle and they position accordingly. And right now, bonds make sense again. Third, real assets with pricing power. This is the inflation hedge. Because if I'm wrong, if inflation stays elevated or reaccelerates, you need assets that benefit from that environment. And real assets, real estate, commodities, infrastructure, energy, these appreciate when inflation runs hot. Let me be specific. Real estate investment trusts in sectors with strong fundamentals. Industrial real estate, data centers, cell towers. These are assets with long-term leases, built-in rent escalations, and demand drivers that aren't going away. You're getting income, you're getting appreciation, and you're getting inflation protection. Energy, not speculation, not hoping oil goes to $150 a barrel. I'm talking about integrated majors with strong balance sheets, sustainable dividends, and the ability to generate cash flow across the cycle. These companies are buying back stock, raising dividends, and trading at reasonable valuations after being ignored for years. Commodities, not directly because most people can't manage physical commodities or futures, but through diversified commodity funds, through companies that produce commodities, through infrastructure that supports commodity production. This is the part of your portfolio that performs when everything else is struggling. And again, this isn't about predicting the future. This is about diversification. This is about owning assets that perform in different environments so that no matter what happens, some part of your portfolio is working. That's how you protect capital, not by hiding in cash hoping nothing bad happens. Fourth, international equities in undervalued markets. The US market has outperformed everything for 15 years. It's expensive, Valuations are stretched. Everyone is overweight US stocks, and that creates opportunity elsewhere. Europe is trading at a discount. Emerging markets are trading at a discount. Asia outside of China is trading at a discount. And while everyone's focused on the S&P 500 and the Mag 7, there are quality companies in other markets trading at half the multiple with similar growth rates. Now, this requires work. This requires research. You can't just buy an emerging market index and hope. But if you're selective, if you focus on quality companies with strong franchises and growing markets, you can get better value and better diversification than piling everything into US large caps. And here's the thing. The dollar has been strong for years. When the dollar weakens, and it will eventually, because that's what happens when you run massive deficits and print money, international assets appreciate in dollar terms. So you get the underlying asset appreciation plus currency tailwinds. That's the double benefit of being positioned globally when everyone else is US only. Now, let's talk about what people get wrong when they try to deploy cash. The biggest mistake is trying to time it perfectly. They wait for the bottom. They wait for confirmation. They wait for the all-clear signal. And it never comes. Because by the time everything feels safe, the move is over. Prices are higher. Valuations are extended. And they end up buying at worse levels than if they had just deployed consistently over time. Here's what actually works. Dollar cost averaging with a deadline. You take the cash position you're holding, you divide it into equal chunks, and you deploy it over 3, 6, 12 months on a fixed schedule. You're not trying to pick the bottom. You're just systematically moving from a losing position, cash, into productive assets at average prices over time. And you commit to it. You don't pause if the market drops. You don't accelerate if the market rips higher. You just execute mechanically. Because the goal isn't perfection. The goal is participation. The goal is getting your capital working instead of sitting idle. I've done this dozens of times across 4 decades. I've never once nailed the exact bottom. I've never once had perfect timing. But I've consistently outperformed people who waited for perfect timing because I was in the market compounding while they were on the sidelines calculating. And the math is simple. If you're holding $100,000 in cash, losing 2% a year to real inflation, and you deploy it into a diversified portfolio earning 7% annually, that's a 9% annual swing. Over 10 years, that's the difference between $83,000 in purchasing power versus $197,000. You more than doubled your outcome just by being deployed instead of waiting. That's not magic. That's not market timing. That's just basic asset allocation and the power of compounding. But most people never get there because they're too focused on avoiding short-term volatility instead of capturing long-term growth. Let me address the obvious counterarguments. What if the market crashes right after I deploy? Then you buy more. That's not a problem. That's an opportunity. If you're diversified, if you're invested for the long term, market crashes are buying opportunities, not disasters. The only people who get hurt in market crashes are people who panic sell or people who need the money immediately. If you don't need the money for 5, 10, 20 years, a crash is irrelevant to your outcome. And here's the reality. The market crashes sometimes. That's part of the deal. But it recovers. Always. Every single time in history, the market has made new highs after every crash. Every recession, every bear market, every crisis, followed by new highs. So if you're worried about deploying because the market might go down, you're worried about something temporary while ignoring something permanent, which is that cash loses value consistently. What if inflation comes back down and cash becomes attractive again? Great, then you're already deployed in assets that benefit from a stable, low inflation environment. Stocks do well in low inflation. Bonds do well in low inflation. You win either way. The only scenario where holding cash makes sense is if we go into deflation, and deflation hasn't happened in a meaningful way in the US since the Great Depression. I'm not positioning for an outcome that has a 1% probability. What if I need the money? Then you shouldn't be deploying it in the first place. I'm not talking about your emergency fund. I'm not talking about money you need in the next 6 to 12 months. I'm talking about excess cash that's sitting there because you're scared, or because you're waiting for the perfect time, or because you haven't made a decision. That money should be deployed. If you genuinely need liquidity, hold 3 to 6 months of expenses in cash and deploy everything else. The point is this. Every objection to deploying cash is based on fear of temporary volatility. And temporary volatility is not risk. Permanent loss of purchasing power is risk. And that's what you're taking by holding cash. Here's what happens if you ignore this. You hold cash through 2026. Inflation runs at 4%. Your cash earns 2%. You lose 2% in real terms. That's year one. Year two, same thing. Another 2%. You're down 4% cumulatively in purchasing power. Year three, you're down 6%. And meanwhile, the market has gone up 20, 30, 40% from where it was when you decided to sit in cash. And now you're not just down 6% from inflation, you're down 40% in opportunity cost. You missed the entire move because you were waiting for safety. And at that point, you have two choices. You can admit you were wrong and deploy at higher prices, or you can keep waiting and fall further behind. Most people keep waiting, because by then, it's not about strategy anymore. It's about ego. It's about not wanting to admit they made a mistake. And that ego costs them years of compounding they'll never recover. I've seen this play out more times than I can count. The person who went to cash in 2008 and didn't get back in until 2013. The person who sold in 2020 and missed the entire recovery. The person who's been waiting for a crash since 2016 and has missed 8 years of gains. They all thought they were being smart. They all thought they were protecting capital. And they all got destroyed by inaction. Because here's the truth. In investing, doing nothing is not neutral. It's a decision. And it's usually the wrong one. So here's what you do. You audit your portfolio today. You look at how much cash you're holding, and you ask yourself one question. Is this cash here because I need it in the next 12 months, or is it here because I'm scared? If you need it, fine, keep it. That's liquidity. That's planning. That's smart. But if it's there because you're scared, because you're waiting for certainty, because you're hoping for a better entry point, deploy it now. Not next month, not after the next Fed meeting, not after you see how the market performs in Q1. Now. Take that cash, divide it into 6 equal pieces, and deploy 1 piece per month for the next 6 months into a diversified portfolio of dividend equities, short to intermediate bonds, real assets, and international exposure. You're not trying to be perfect, you're just trying to be in the game. And then you stop checking it every day. You stop worrying about every 10% pullback. You stop trying to time every move. You let compounding do what it does, which is turn deployed capital into wealth over time. That's it. That's the entire strategy. It's not complicated. It's not exciting, but it works. And it's worked for 100 years. And it'll work for the next 100. But only if you're deployed. Only if you're participating. Only if you stop treating cash like safety and start treating it like what it actually is, which is a depreciating asset that you're holding too much of. I've been managing capital through 7 recessions, 4 market crashes, 3 wars, 2 pandemics, and more Fed cycles than I care to count. And the pattern never changes. The people who win are not the people with perfect timing. They're not the people who called the top and the bottom. They're the people who stayed deployed, who stayed diversified, who kept their capital working through uncertainty. And the people who lose are the ones who think they're being conservative by holding cash, who think they're being patient by waiting for the perfect moment, who think they're protecting capital by avoiding volatility. They're not protecting anything. They're guaranteeing underperformance. So you have a choice. You can take the temporary discomfort of deploying into an uncertain environment, or you can take the permanent loss of sitting in cash while inflation and opportunity costs destroy your wealth. One of those is uncomfortable for a few months. The other is catastrophic over a decade. I know which one I'm choosing. I've been deploying aggressively for the last 6 months. I'll keep deploying for the next 6, because I don't need to know what happens next quarter. I just need to know what happens over the next 10 years. And over the next 10 years, deployed capital outperforms cash. Every time. The question is whether you're willing to accept that reality and act on it, or whether you're going to spend the next 5 years convincing yourself that waiting is a strategy. If this resonated with you, if you're realizing that sitting in cash is costing you more than you thought, do 2 things. 1, subscribe, because I'm going to keep breaking down the macro environment, the sectors that make sense, the strategies that actually work in this cycle. No hype, no predictions, just analysis based on 40 years of managing capital through every environment imaginable. 2, watch the next video. We're going to go deeper into portfolio construction for 2026, specifically how to position for multiple scenarios: inflation, deflation, growth, recession, so that you're protected no matter what happens. But only if you're serious, only if you're actually managing capital. If you're just here for entertainment, if you're looking for someone to validate your decision to hold cash, you're in the wrong place. This is about wealth, real wealth, and the decisions you make in the next 90 days will determine whether you spend the next decade building it or watching it erode. Your call.